Welcome back. In this business finance lecture, we'll go over study problem 9-9 in page 299 from the 8th edition of our textbook. Here's a view of the problem. Let's highlight some key facts given in the problem. We have a common stock, which is currently selling at $58. And if a new issue is to be sold, it is estimated that flotation costs will be 8%. Now, let's be very careful on this part of the problem. So the company pays 50% of its earnings in dividends. In this case, dividends were $4 recently. So with this information, it is obvious that the earnings per share in the current year is basically $4 divided by 50%. So $8, right? So that makes perfect sense. So your earnings per share were $8. 50% of it you gave out as dividends to your shareholders, and the remaining 50% has been retained by the company. Now, what's interesting though is earnings per share 5 years ago were $5. So that would be earnings per share. For sake of notation, I will say -5. So earnings per share currently is at $8, but 5 years ago that figure was a mere $5. So why are we given these figures? So the next part will reveal that. So earnings are expected to continue to grow at the same rate as they did in the previous 5 years. So we are to figure the growth rate using these two numbers of EPS 0 and EPS earnings per share 5 years ago. So the fastest way to make that calculation is again to use the third row of our financial calculator, and let me reproduce it here. So for the past 5 years, what is the growth rate? So this is a surprising result. I'm using the I/Y key to calculate the growth rate. How amazing is that? So the present value, so it's as if you made a $5 investment 5 years ago, no payment during those years, and then the future value has grown to $8. So you compute I/Y, and this should give you roughly 10%. So that's the growth rate of dividends. So now we can go back to our problem. We are given that the tax rate, the company has a marginal tax rate of 34%, and we are to figure the cost of capital for internal common equity and external common equity. So let's start with the first part. So for internal cost of internal equity, that's internal equity, that would be simply D1 over, because it's internal, the net price is basically the price itself plus G. So that would be equal to D0 times 1 plus G over price plus G. We are given that D0 is $4 recently. So that would be $4, and the growth rate 1 plus 10%, all divided by the current market price is $58 for this stock, and we add at the very end the growth rate again. And from here, making the calculations, the cost of internal common funds would be standing at 17.59%, so relatively cheaper, as you will see next. The cost of external equity, external means we need to raise funds by inviting external investors, and for that we will need the help of an investment bank. So that will change the price figure, right? So the dividends, there's no change in this calculation, 1 plus G. However, for price, I should be using rather the net price, which is price times 1 minus flotation cost. And then I finally need to add the growth rate again. So the numerator, as I said, is the same thing. So $4 times 1.10 divided by the price was $58, the price of our common stock. However, we have to give 8% commission to the investment banker, and we add back the 10% as well. So making this whole calculation, we realize the cost of external equity stands at 18.25%. And that's not a surprising result for us. When we do not use the help of a broker, raising funds is cheaper than compared to using external investors and the help of an investment bank. So that should solve our problem, and I hope you enjoyed this video, and stay tuned.